The following is a presentation of TFNN.
All right, welcome everybody. This is Don Kaufman of ThinkorSwim by TD Ameritrade for the Options Hour. So welcome everybody to the show. As you guys know, this is a call-in show here to answer your option questions. Call us really about anything, stocks, options, futures, you name it. You got a good convoluted type option trade, we are here to answer it. Anyway, this is good. There's already questions being chatted in right now. Give us a call at 877-927-6648. We are here again to answer your option-related questions. And if you got any ThinkorSwim-related questions, anything you guys got. So, somebody chatted in. Let's talk education. All right, trades. So, Obi-Wan, you tell me, okay, what is your question out there, Obi-Wan? So, of course, I'm reading your chat room over here. We're going to have callers on the line. I've got a couple of good emails. By the way, I don't mind if you guys ever email me in regards to questions, and I'll answer them live on the show. You basically can email me anytime during the week. I'll answer them, on the next week's show, or I'll email you back. Anyway, with that, my email address, D Kaufman, K-A-U-F like Frank, M-A-N, at ThinkorSwim.com. If you've got any questions, of course, you want to shoot in there. So we only have 1 hour, but trust me, we can answer a lot of questions on here. So we'll do a quick market recap here in just a moment, which I'm sure everybody's watching right now. But again, give us a call as we go along over here, 877-927-6648. All right. With that, ES futures, of course, our SPOOs, which is the E-mini S&P 500 future, down 350. This is the big move in the day. For those of you that are not watching the market all day, I've pretty much watched every single tick this morning. I basically left to grab a cup of Starbucks and run back up. And by the way, I am coming to you not from Scottsdale, Arizona this time around, but no, I'm on the road. Actually, I'm on the road doing a show out in Los Angeles this evening for TD Ameritrade and ThinkorSwim, along with Tom Sosnoff, and I come to you live from the Hyatt Regency in Century City. I don't like doing these shows on the road. I'm a little cramped in here. My one tiny little screen. I don't have like 3 or 4 monitors around me. I guess like separation anxiety from all of my technology here. Anyway, with that, just take a look at the futures. Futures now are down 3 on the day, and this is actually cracks me up because the futures being down 3. This is the biggest move we've seen all day. If you guys take a look, again, I'm not much of a market technician, but you take a look over at the chart and also the daily high and daily low. This daily high and daily low here also includes the overnight trade on these futures. We've had less than an 8-point range. This is what we call an inside day. Obviously, a pretty good-sized rally yesterday. However, if you guys saw the rally yesterday on extremely, extremely low volume, I mean, it was just, there was nothing moving yesterday. In fact, futures traded up 20, and they sat there the entire time. It was just brutal, absolutely brutal out there. So we've got a couple of questions coming in. We will talk about the market maker move on the platform. I've also got another caller right now, and of course, you can call in at 877-927-6648. Let's take our first caller. It's Ari from, looks like Arcadia, Florida. What do you got for us, Ari? You there?
Yeah.
Yeah, what do you got?
I've never done this before, but I like a stock, SLW, okay?
Okay.
I like to purchase a leap on it and sell calls as it goes.
All right. So,
I have no idea where to buy the leap in, and how would I structure the short-term calls that I would sell against it.
All right. So you're thinking about buying a deep in-the-money leap and using it as a stock substitute, I'm taking it?
Yes.
Okay. The question is, well, first of all, this particular underlying is Silver Wheaton Corp. I've seen it a couple times here and there. Volume on it ain't half bad. Stocks volatility is pretty decent too. You're looking at about a 50% vol on here. The reality is this: buying these deep in the money leaps is not necessarily a great substitute, okay, for a stock replacement, especially when volatility in these back month options, when I say back month, I'm looking at the Jan 2012 right now. There's 300 days left, and your volatility is all the way up at 57%. The problem with that is in the front months, which is like April, May, you're only selling like a 48 or a 52%. So by buying the January, even a deep in the money option, you're exposing yourself to considerable what they call vega or volatility risk. This is something that I've talked about to clients again and again and again. If you're considering like buying a leap, a stock replacement, and then selling monthly calls against it, you may want to consider, and you might be better off, utilizing an option with a little bit of a shorter date and buying it deeper in the money because you're lowering your volatility risk. So for the most part, I would actually consider looking out to like a June, which is only 87 days out, and buying that option deep in the money. It's going to have less extrinsic value, which is, of course, time value, all right, and the option that you buy that's deep in the money in June, which is only 87 days out, okay, that option is going to have less exposure, of course, to implied volatility risk. It's basically, we really, when I look at this, I can't really say that buying an option any further out than about 150 days really starts to expose you to pretty good amounts of volatility risk out there, and it's something that's not often thought about by a lot of traders. So you can buy, for instance, June deep in the money and sell in April against it. Then, of course, you can roll that to May, and then when June comes up, you just roll the trade out a couple of months from there. Does that sound okay? You kind of know. You're kind of following along as I go along.
I'm following it okay, but I still wouldn't know where to buy. Where would I buy June, and what would I sell the May or April?
Right.
April, I guess.
Yeah.
I structure it. I'm following you.
Sure. When you look at the June option, you want to go in the money, make sure it's got probably like an over an 85 delta. So you're right around, I'm going to say like the 33 strike in June. And that 33 strike in June is going to cost you about $10. Ultimately, all you're again doing here is like a stock substitute strategy, and there's nothing wrong with that. But again, if you buy a deep in the money option, it is an okay substitute for stock. But the reality is, it's still tying up $10, per share on this underlying. That's only a $40 underlying. If you went out and bought the underlying, of course, on Reg T margin, it's only going to tie up $20 a share. So that's something that you may want to think about, is that you could just go out, of course, and buy the shares themselves and sell calls against it. Your exposure, of course, on the shares is going to be considerably more. If the stock, tanks all the way down to $20, obviously you've got pretty huge downside risk. But if you buy those in the money, those 33 calls that are deep in the money in June, your risk is limited, of course, to about $10 there. And those things have very little extrinsic value associated with them. So, of course, that's a play you could definitely do. One other thing that you consider is, and by the way, after you buy these 33s that are deep in the money, you look to April and go right out to like a 30 or 40 delta call and just sell a 30 to 40 delta call against, your long Junes. So you're long the June 33s, you're short, of course, the April, let's say, 44s. You're about one strike out of the money there, and that'd be fine. The other thing you could, of course, do is if you think the stock is going to be relatively range-bound, is you can just utilize straightforward calendar spreads. That is, sell, for instance, the April 44s, buy, for instance, the June 44s. And that's just a straight calendar spread, which is also, not similar, I should say, to a covered call, but it's the same properties of selling premium. It just depends whether you think the stock is going to appreciate up or not.
On the 44 call that we just did,
yeah.
If my April 44 call is taken, then ThinkorSwim will just go and exercise my June, right? That's how
you wouldn't want to do that. Let's say that you're assigned on those short. You're short these 44 calls, right? Let's say you're assigned. All right, that just puts you in a short stock position. You could just buy out the stock and then roll the call anyway. And basically, that's just not gonna happen. Okay, that's just really not going to happen unless you fall asleep at the wheel at expiration. You could be assigned in those 44s, but again, all you have to do is if you were ever assigned early, don't panic. You're long, those in the monies in June, and all you have to do is basically cover the short stock and roll the position out to May, and you're fine. It's really straightforward. And if you ever have a problem with that, of course, the guys on the ThinkorSwim trade desk are fantastic. They're going to walk you through, substituting out the stock for and rolling that option there. So never panic if you're assigned early. Just give us a call. We'll walk you through the entire thing. So you all right?
Appreciate it.
Yeah, send us an email sometime. So, all right, excellent call right there. And jump back over here to my monitor screen. We're talking about a little bit of a market recap. Again, absolutely nothing has happened. And we've already got another caller ready for us. So we have a special guest caller today. Are you there, caller?
I'm here, caller. I'm here, host.
All right, on the line, actually, we've got Tom Sosnoff, who's out in California with me right now, doing a show here at the Hyatt Regency in Century City for TD Ameritrade and, of course, ThinkorSwim clients. So, how you doing, Tom?
Hey, first-time caller.
First-time caller, long-time listener. Is that what you're doing there? Yeah.
Long-time host, listener, yes.
Yeah.
So, I've been listening. Good stuff.
Yeah. What do you think, man? This is kind of an inside day here.
Yeah, it's been the last 2 days have been. They basically opened up $20 yesterday and stood there, the whole day, up $18, didn't move once. Today they've essentially opened flat, maybe up $1, at max, and they've been trading down about $1 to $2. The S&Ps have all day. The Nasdaq's been strong on the heels of Netflix, and Apple was up a couple bucks earlier, and Baidu and stuff. But generally speaking, this is truly an inside day. The Russell got weak, which I think is an early warning sign. The Russell futures are down $5.50. That's a little bit of a warning sign. Gold's starting to sell off a little bit. It's down $2.30. And I'm not sure, but I think that's a huge rally, Don, from 1250 to 1295, and in spite of everything that's going on around the world, I think that we got to a point where we got tired, and I'd like to see them pull back. I mean, 1280 would be an absolute minimum. 1275, which is only another 10 or 15 points lower. The S&P is about 1%. I think that's a starting point, and then we see how they act when they get down there.
Yeah, no, I actually agree with you. I mean, yesterday that rally was on absolutely no volume, too. I was talking about that a little bit earlier there. And, man, yesterday was amazing. We opened up 20, and we literally pegged it all day long. I mean, the futures had like a three-handle move, for 5.5 hours yesterday.
Well, volatility contracted almost 20% yesterday. It was down, just about 20%, and it's down again today. It's actually traded under the 20 handle, and it was just up to 30 just a couple days ago. So, it's been we've lost 30% of the volatility of the market in less than 4 or 5 days. I think things have really normalized here, and the market's it's playing tug of war at this 1290 level, and I don't see the upside being breached today. That's for sure, because the S&Ps are too weak, but the Nasdaq's trying to keep it in there. Usually when the Nasdaq's the only positive, the only kind of bright spot, the market has a hard time. But the Dow's only down 4 points, and the S&P's only down 3. So it truly is like watching paint dry today. It's very inside.
Oh, yeah. Take a look at the bonds. There's a couple of guys chatting in right now if you're still trading like TBT, TLT, and obviously completely flat on the day. But this is a tough call also, because I see TBT is also kind of playing that tug of war. It had its little bit of a sell-off here. Obviously.
Yeah. Well, the only thing I'd say is that if you're bearish on the market, like I am, I know everybody say you always are, Tom, but if you're bearish on the market up here at these levels, you'll probably have a chance to buy. If you want to bet on interest rates going higher, you want to bet on TBT being lower, you'll probably have a flight to quality. At least, maybe it may be very short-lived, but it may just, may take TBT back under 36. Personally, I'd like to see it get towards 35. And I think in the 35 handle, it's just going to be rock solid. That's going to be a rock solid support level for TBT in there. So I think the key number in bonds are currently trading, the long bond's trading 121.08. The key number in the long bond is 122.5 to 123. So that's about $1 in TBT price, or that's about $1.50 in bond prices. And I think if you get a sell-off, you get a nice flight to quality in bonds. Really, one of the great plays on the board will be to get basically bet on interest rates going higher. I think there's no chance they go lower, except in the scenario of a flight to quality.
Right, and that's going to be kind of a knee-jerk panic reaction if we sell off hard.
It'll be very short term.
Unusually, I agree with you on TBT there that 35 is pretty much the solid support on that. Yeah,
and it could be 35.5. Who knows? You have to see. But I think it's got to get down into that 35 handle on a sell-off in the market in order to get in order for it to be really attractive, at least to me.
Yeah. Looks good. And oil again, of course, is on the rise today, which is that's obviously been in play a lot the last couple of weeks here. But I also think that that's a little bit range bound right now. With that 105 is tough for it to breach as it tried earlier today as well.
Yeah, I think all the risk in oil is to the downside, believe it or not. I don't think the risk is to the upside. I think if there was a risk premium built into oil, it doesn't exist anymore. I mean, listen, we're already bombing, and, I'm not sure what the risk premium out there would be. So I think that in oil right now, the risk is to the downside, not to the upside. I think the risk premium has pretty much been taken out of oil to the upside.
Good stuff. Good stuff. So you ready for the big show tonight?
I am. I'm ready.
All right. Hey, got anything else for us, or we got a couple other callers on here that we're...
No, I'm going to let you guys go because I want people to get their questions answered. It's a great show. Thanks for taking it over for me, and to everybody that's out there, as we like to call him, Don Juan knows his stuff. So
I'll see you in a couple hours.
Okay, Don.
All right.
We'll
thanks
talk
a lot, Tom. Bye. So, all right. An interesting caller over there, Tom. Hey, don't chat in. He's great. He's all right. I've actually been traveling around with Tom now, literally the last 11 years on the road. At the beginning of ThinkorSwim, obviously, when we did the deal with Invest Tools, obviously now TD Ameritrade, and it's interesting. Nothing ever changes with us on the road. Just really the same crap, 11 years passing over there. And I always tell people, I literally grew up at ThinkorSwim. I joined Tom and them when I was 24 years old, and I've been with those guys ever since. It's of obviously Tom Sosnoff, Scott Sheridan, a couple of the other partners originally with ThinkorSwim. Fun stuff. Anyway, with that, let's jump back to the show. So, wow, futures now are massively unchanged pretty much on the day here. So, E-mini futures down about 350. Give us a call. So, I'm seeing some people chatting in some questions, and I'm going to answer them as I have not forgotten about you. I'm definitely going to answer a couple of questions as we go along today, just kind of ticking through here, a couple of symbols, and ultimately, we are here to answer your calls. And, of course, the number is 877-927-6648. So give us a call with any option-related questions or anything Tom was just mentioning here. It's interesting over the years. You find that a lot of traders, myself, of course, included, become contrarians. And if you ever listen to Tom over the years, you'll notice that he's a big-time contrarian, as am I. This particular market had, obviously, a pretty good bounce after selling off hard a lot last week. Pretty good bounce to the upside here, but we are really struggling at that futures level, of course, of 1290 right now to breach that. And it is a bit of a tug of war right now on extremely low volume, as was, of course, yesterday, a rally that, after that rally, futures were up 20 and basically moved within a 3-point range for 5.5 hours. In many, many years, I haven't seen that tight of a futures range in an open market in literally years. So with that, I want to jump to a couple of questions that I had come up on email and a few people that are chatting in. And explain it. So I've pulled up here, if you guys are taking a look at my screen, and I also see another question coming in from like G7 over here, so I'm going to grab that one in just a minute. But I want to talk about what's called market maker move here on the ThinkorSwim platform for a little while. And typically I don't like to make this radio show about all different types of software and technology. It's not about that. It's about you guys getting your questions answered. But there's a kind of a cool feature that we built into the software on ThinkorSwim that a lot of you guys listening right now are on this platform anyway, and I figured, hey, I'll cover this in a little bit of detail. So with that, I go over to the Trade tab, and I typed in Yahoo, and kind of in the upper right-hand side of my screen, you'll see kind of a yellow little oblong circle here, little ellipse, and it says MMM, and that stands for Market Maker Move, and then it says plus or minus 37 cents. So let's talk about what this really is, because it's kind of a newer feature on this particular platform. But even if you don't have ThinkorSwim and you guys are listening to the show, you have no idea what a ThinkorSwim even is, that's fine, because I just want to talk about it. So implied volatility. Okay, and I've talked about implied volatility a couple times on this show. Implied volatility is really, all right, the supply and demand, all right, and is set by supply and demand in option premium. So when you guys look at an option and you're like, okay, that option is trading for $1, whether you buy or to sell it, the market's $1 by $1.01, right? That's how tight option markets are. And every time I've ever done this show now, I talk about, the tightness of markets, the bid-offer spreads are just, absolutely killing it close here. And the bid-offer spread is basically $1, $1.01. So that option's trading for $1. But ultimately, when an option's trading for $1, well, how did it get priced that way? Is basically supply and demand. It's bids and offers coming in. It's what somebody, of course, is willing to trade that option for. It's not like a Black-Scholes model. Black-Scholes model helps you revert back to option pricing, helps you revert what the implied volatility is. But ultimately, in the end, all right, supply and demand is really what sets option premium. So with that supply and demand, we extrapolate that out to how far a stock can move in a given period of time. So we got another caller here, which I promise I'll get to in just a minute because I know, he's called in a bunch of times. But I just want to kind of cover this, and we'll jump back to market maker move as we go along here. But if you take a look at, for instance, a stock, and the stock was trading for $100, and that stock had a 20% implied volatility, all right? So that implied volatility really entails that stock, all right, can move up 20% or down 20% within 1 year of time, and it will stay in that range approximately 68% of the time, which is, of course, one standard deviation. So what you get is basically an implied volatility, again, of a $100 stock with a 20% implied vol. The 20% implied vol, if you extrapolate that as risk, okay, which implied volatility is, you can also then estimate how far a stock can move within a given period of time. Ultimately, what we do is we take this implied volatility and we divide it out. Of course, if you divide it by 12, all right, you can see how far a stock can move within a given period of a month. If you divide it even further than that, you can feasibly figure out how far a stock can move literally every single day. And that's what Market Maker Move is based on. This 37 cents says that based on current implied volatility, all right, basically this underlying can move approximately up or down 37 cents a day, and it will stay in that range approximately 68% of the time, which is, of course, one standard deviation. And somebody says, well, 68% of the time, what happens the other 32% of the time? Well, don't worry, you'll find out. No, it's just, those are a little bit more abnormal moves. So you can basically say 68% of the time we stay within this range, up or down 37 cents. So with that, and we're going to jump, of course, back to that logic here in just a couple of minutes. With that, let me take another caller here, because this is a call-in show, and I'm actually chatting with a couple of you guys over in the Tiger Den. You always chat in your questions because I'm reading them over here. But again, give us a call because it makes it more interesting for everybody. 877-927-6648. Let me go to Jim in Seattle on City. Jim, you there?
Yes, I am, Don. Good morning to you.
Yeah, good to hear from you again.
Don, I've got a large block of Citibank that I'm looking to hedge, and I'm looking at the prices for these options are really low on these things, and I'm wondering how in the heck how I hedge myself a little bit and still, garner some either on a covered call or something else.
You've heard me a bunch of times, obviously, on the show. There's a definitive term, hedge. So when I think of the word hedge, I think of it buying. It's a definitive term for buying physical protection. But then I think about an enhancement. Okay, a hedge is buying a put. Okay, a hedge is actually physically going out and buying some type of insurance. An enhancement would be going out and selling calls, out of the money calls. And to be honest, on something like Citi, I like the idea of the enhancement. A hedge on a $4.42 stock isn't going to do all that much for you. And that is because it's using dollar strike increments out here. I'd hate to see you buy a 40-cent option, or something like that. Obviously, if you take a look at April, the options, the 4 puts are trading for nothing. If you go a little bit out into the future, even June, they're trading for 8 or 9 cents. You know what that says to me? It says there's almost no probability of it going down. That being said, you can collect a little bit of premium here by selling calls. Now, there's something interesting I want to talk about to you on Citi, and it's outside the idea of a hedge, and it's outside the idea of an enhancement, and it's this. Citi, obviously, being a financial, stands to benefit greatly from interest rates possibly rising. And you can take this call yourself, but ultimately, every financial firm out there is sitting with billions and billions of dollars, okay, of capital. And one of the primary ways these companies make money is, of course, yielding a small spread on your capital. All right. Right now, with interest rates sitting at 0 or 0 to 0.25%, we can't really yield anything. When I say we can, I mean, hey, I happen to work for a large financial firm. I'm not going to comment again on anything, in our firm related, but ultimately, as interest rates rise, our spread and our yield is likely higher in this industry. Ultimately, the city may benefit greatly from a rising interest rate environment. Being long TBT out there, similar being long city or being long XLF, and there could be some decent upside on a few of these underlyings here. City, of course, included in that category. Yeah. So you okay over there?
Yeah.
All right. So for the most part, your option here is not that plentiful. I mean, you basically, if you buy puts, they're trading for next to nothing out in June. You can sell some calls. Selling calls, of course, is going to cap your upside. Maybe you sell calls on half your shares. But ultimately, even going out to June, 87 days out, the 4.5 calls are still trading for 20 cents. You're not collecting a lot of premium out there. So that's something you're going to have to obviously take a look at. There is one other thing you could possibly do. If you own a decent block of Citi, you could go out and sell call spreads in the XLF against your Citi shares. Have you ever thought of that before?
Yeah, muddies the water.
All right, so I'll jump over to XLF. Are you taking a look at the screen show right now?
Yeah, I am. No,
okay.
I've got it in front of me.
Yeah, if you take a look at the screen show, I'll just utilize like the May options here. And what you can do, you can't collect a huge amount of premium on these, but you could go out, for instance, and like sell a vertical, and a $1 wide vertical here is it's still only trading for about 20 cents. It's not great premium here. Okay, not much better than what you were going to collect over in Citi, but you're utilizing a spread because ultimately XLF has obviously a very tight relationship with, of course, Citi. And selling a spread in XLF against your Citi shares is something that you could feasibly do to bring in premium against the long Citi shares. You all right with that one?
Yes, I can see that, Don. Now, would you also balance these off the beta on these?
Yeah, so what you basically have to do, you could do a beta-weighted, that's no problem, or you can do what's called notional value. What notional value basically is figuring out how many shares of...
4 versus 16.
Right, exactly. So you can divide it right into 16, because the volatility is similar between XLF and Citi. I mean, they're not drastically different.
They're not too, I see that.
So just keep that in mind. Just keep it in mind is, Citi sits right around a 30% volatility. XLF's a little lower, obviously because it's a major index. And that's again, it's a great way to consider doing this.
Okay.
Yeah.
All right, I'll give it some more thought on that then.
It's tough with a $4 underlying. We always laugh about that because Citi basically is, like an option being a $4 underlying. But of course, a lot of underlyings today going through reverse splits. And that's obviously one that's in play for that. So you may get some better flexibility here in a reverse split situation where the option premium might be a little bit more decent, in the next couple of months if they reverse split it.
Mm-hmm.
All right.
Okay. All right. Thank you very much.
Right. Good talking.
Bye-bye.
Thanks. All right. So again, great call. Something interesting there, which is utilizing an index, like XLF against, of course, an individual underlying. And people are like, wait, it doesn't have 100% correlation. The XLF doesn't correlate Citi perfectly. I know it doesn't. For the most part, though, what I'm doing is selling calls in the XLF against my Citi shares. What's interesting, though, is when you sell this call spread, selling a call spread does not completely cap your upside there. Okay, so, all right, with that, we've got another caller here, and we'll jump back to Market Maker Move in just a few moments and talk a little bit about that. But if you are sitting there, give us a call. The number is 877-927-6648. With that, let me go to Bill in Massachusetts. Bill, you with us? I don't hear you,
yes,
Bill.
Good morning.
You there?
Yeah, I'm here.
Oh, good. Good deal. Sorry, I didn't hear you there for a second.
I have a question about a strangle on the IWM.
Yeah. You emailed me about this, didn't you?
Yes, I did.
I was going to talk about this if I had time. So this will work out great. Go for it.
I set the strangle up when the IWM was at 79.
Okay.
So I sold the 77 calls,
Okay.
and I sold the 81 puts.
All right. So you're actually in the money. You sold in the money calls and in the money puts?
That's right.
Okay.
So now, as this thing goes up towards 81, obviously that's the range of my, that's the top of my maximum profit there. And, if it gets away from me to the upside, then, I'm looking at losing money.
Right.
So, but as it gets to 81, the put is in the money, the put has a profit on it now.
Correct.
It's going up, and I've sold it.
Correct.
So what I did was I rolled it out to 82.
Okay.
Which gives me more space, and it also seems to me like I'm capturing, the profit that I already have in that leg.
Sure, there's an exact phrase for what you're doing, and this has been used for years and years by market makers. Basically, what you're doing is called gamma scalping. You're actually reverse gamma scalping. A gamma scalp starts with a straddle. You basically buy a straddle, and if the market moves up, you sell off some of the calls, and the market moves down, you sell off some of the puts as you're profitable. And it's basically trying to maintain relative delta neutrality, and you're actually scalping options, okay, against the movement to keep the delta very, very neutral. And that's basically what you just did. Utilizing in-the-money options, I don't know if I did this myself, I probably wouldn't utilize the in-the-money options. And the reason being is the in-the-money options didn't have as much extrinsic premium, as much time value. So I may have actually used slightly out-of-the-money option, and of course, as we rallied up, you buy back some of the puts, okay? And then you sell back off, and of course, you can sell more puts and then buy back the calls. And you just really are looking for this stock to kind of oscillate between your call strike and your put strike. And that's
so you're talking about taking an...
Go ahead.
Well, I have two questions here, but now you've made me think of another one. You're talking about the out-of-the-money option, but the reason I set it up this way was to make that spread really wide, the probability on this thing. I mean, I've got it running from 77 to 81.
Right. Where
a wide plateau around my strike price.
Absolutely, absolutely. Which
I can sleep better on.
Right, and it would have worked out very similar to sell out-of-the-money premium, but I understand. You definitely tried to protect yourself using some extrinsic or intrinsic value rather than just time value. So, you're actually fine what you're doing right now. So
my question is, it just seems too good to be true. I mean, what I've done is I've taken money off the table, and at the same time that I did that, I lowered my risk by moving the call out to 82 instead of where it was at 81. So,
you said your put or your call out?
Right, the put.
Okay, so you've now rolled out to 82, yep.
I rolled out to 82, which widens my plateau from 77 now to 82, and also I take some money off the table.
Right.
By buying back that put that's profitable.
Right. So where does this trade go bad?
Yeah, where's it?
One big move and you're toast. That's
well, yeah.
Basically, so you're short, strangled, so if we get a large move is where you're going to get hurt. And, ultimately, when you look at this strategy, it's fine, but you got to be able to, number one, you got the margin, obviously, because when you're selling, naked on either side of the market, your margin ties you up a little bit, which for some people, hey, go to it. I actually got no problem whatsoever with your trade, as long as you have a stomach for the idea that if we move $10, things are going to get a little crazy for you. And hopefully we don't gap like that overnight, but that's always, a fear. So, your losses aren't huge. What's interesting about this strategy is this makes money month after month after month. It has really relatively high probabilities associated with it. Where it breaks down is in that big catastrophic move. And
when there's an earthquake, yeah.
Right. And you know what? There are ways to hedge the risk. And what really kills a lot of people is on a strategy like this, listen, you're on IWM, which is only open, of course, during market hours. But if all hell were to break loose at night, which it does, and it did, last week, you got to be nimble and understand that you can use Russell futures against your IWM position. And you can actually hedge some of your risk. If you thought we were really going to melt down big time in this market, you could, of course, sell a future to hedge off some of that downside risk on this position. And that's more of a matter of not just looking at profit and loss graphs. Now you're going to have to start to look at the delta of this aggregate position. And it'll make you a lot more effective, though, if you start to understand some of the Greek and the Greek risk, and you start to really add up the deltas and watch them on the monitor tab. It'll take you to the next level for sure on this thing.
Yeah, well, I didn't know there's going to be an earthquake tonight.
Yeah, you know what, man? That's exactly. You never know. You never know. And last week, I got to tell you, I didn't get a lot of sleep last week. The first time in a long time, I actually traded at night. I remember I was talking to not this past Sunday, but the Sunday before that, about 9 days ago. I was actually talking to Tom Sosnoff at 11 o'clock my time. I'm out in, on West Coast time. And it was like 1 o'clock in the morning, Chicago. He's up, and I'm like, man, you need to get some sleep. He's like, not going to sleep. I mean, because the markets were really rocking at night. And you get that once in a while, but it looked bad. It really looked bad, last Sunday. So that's the kind of move on a position like this that can hammer you. But, you can make money month in, month out on this. You just hope we don't get what we call that 5 sigma or that 6 sigma, which is a catastrophic move one way or the other, and you'd be fine.
Yeah, well, you can sell the condors, but then,
Hey, man, iron condors are great. They're just not as exciting as selling a short.
And that's what I'm saying. I'm too greedy for that. Okay.
No, I totally get it. The only thing is, like, when it really comes down to it on the IWM, figure out, what a catastrophic move is. When I say catastrophic move, you basically look out and you say, okay, the stock's at 80 right now. Would a 12%, I consider a 10 to 12% move a catastrophic one-day move, a 10 to 12% move, will it absolutely destroy my account? And figure out P&L with a 10 or 12% move. And if you're watching the screen show right now, you can go into the Analyze tab, and in the Analyze tab of ThinkorSwim, what it does is I have IWM pulled up right now, and you watching that or no?
No, but I have it on mine here.
All right, so
you
actually pull up in the Analyze tab and type in IWM and hit Reset Slices. It comes up to 10% above and 10% below market, so it shows you that 10% below is $72.68. So it's saying that's what a 10% move equates to. I mean, obviously, everybody can do the math on that. It's pretty straightforward. But it kind of shows you a catastrophic move. So what it also will show you, though, is profit and loss on your trade as if we had moved down to that particular level. And just make sure that your contract size is such that you can sustain that move up or down. I'm a big risk manager, believer in risk management, because being on, helping run a retail brokerage firm for like the last 11 years, I have seen pretty much everything and everybody do pretty much everything in their account. And if there's one thing I would tell anybody that trades is keep the contract size small and under control, because if we do have that move, you want to just live another day. A lot of times people get caught up in a strategy that works 97% of the time. Well, the other 3% of the time, it's waiting for you, but it's waiting for you to put on 50 contracts. It never does it when it has one contract, So that's a little bit of, I guess, the Murphy's Law there in trading. Yeah.
Well, again, thanks for your time.
No problem. And I'm glad I could answer this live for you here, because I was literally reading that email right before hopping on this show here. So shoot me an email anytime you want. I'll try to get them answered on here.
Okay, great. Bye-bye.
Yeah, thanks a lot, Bill. Thanks. All right, so, great call. Somebody out there selling short strangles and kind of scalping against movements in the underlying. I love it. It's actually kind of a version of reverse gamma scalping. It's good stuff. So G7 is chatting in, and I'm just looking on here. But before I get your question there, G7, the number here to call in is 877-927-6648. We got about 10, 12 minutes to go, and we want your questions in here. G7, you may have to actually repeat your question because I can't find it in here. I'm scrolling up. Sorry, man. I'm on one screen today in my hotel. And, I found your question. I'm on one screen in a hotel room over here. I got, like, housekeeping knocking on my door behind me, wanting to clean my room. It's getting much more exciting. And, pretty much close to, like, downtown L.A., so there's absolutely nowhere you can walk over here to outside of the hotel. Tough days on the road. Okay, so let's take a look at your question there, G7. It says, I have a SPY 134, 129 put spread. Should be almost $5, but not even $3 right now with less than 30 days left. Okay, so the bottom line is this. So let's actually pull up this particular spread. We'll go to the spiders. It's an interesting question here, and I'll kind of rephrase it as we go along. So I've pulled up the spiders, and basically what he's got is a 134-129 spread. And if you take a look at the spread right now, and we'll just go like buy vertical, for instance, 134-129 spread. I like taking questions out of here. And the spread is trading for $2.82. So his question is, well, why? This is $5 wide spread. That's in the money. Okay, and it's in the money by almost, by $5. Why is it not working? Well, because there's a lot of time value left, of course, in the 129s. And ironically, the 129s happen to be the at-the-money option, and the at-the-money option is always going to carry the most extrinsic time premium with it. So you got to keep this in mind, that ultimately this spread will not widen out to $5, okay, until, of course, we get closer to expiration and time bleeds out, of course, of these 129s. I mean, this is a tough kind of lesson for a lot of people that are in this particular position. But when you buy a spread and the max of spread can make us $5, and nobody's going to pay you that $5, of course, until, all right, close to expiration, because there's so much premium left in those 129s. This is like one of those other reasons where I like to say, yeah, buying spreads is all right, but selling them gets a lot more interesting. And this is one of the reasons why selling spreads makes a lot of sense. This buying of the spread, you're so profitable right now, and you're getting nervous, okay? And I know that you're getting nervous right now, sitting holding this thing. So you're basically sitting on this put spread, and it's killing you because, man, you're going to make money, and I'm sure you're up a couple of bucks on this thing right now, but all of a sudden, right before expiration, if this market rallies, you're going to get screwed on this particular spread, and that is one of the most painful things. So you got to decide. If you're up decent right now and you've got like 10 contracts in this thing, maybe you basically shave off 3 or 4 of them, maybe even 5 of them, close out half the position, take a little bit of money and run. I don't know what you were into this spread for, but it's tough, man. It's real tough to sit there with a spread like this, because if we do have that rally to the upside, all we got to do is go up $3 or $4 and your spread is kind of toast. You know, from a great spread to not so great. But ultimately, sitting with a $5 wide spread that's in the money by $5, it's only trading for basically $2.80, is, it's kind of a painful experience right now for you. So I'm right there with you, man. And it happens to all of us at one point. And, yeah, he said the spread actually got all the way to $3.50 when the market tanked. You know what actually really sucks is when you buy these put spreads, the market tanks. But when the market tanks, the implied volatility jacks up so high so fast that actually pumps more premium back into the short option, which that's not good for your play in here. So ultimately, you did pretty much everything right, but you got to sit and wait for this thing. In the future, seriously, look into selling some spreads. You know, I'm a big believer of premium selling techniques rather than buying them for exactly this reason. Helps you actually get out of it a little bit quicker than there. Anyway, so hopefully there, G7, I answered that question for you, and wish I could tell you, better things like, but you know what? You can always get out of chunks of it. I'm also, again, big believer, chunk in, chunk out. With that, let's take another caller here, and of course you guys can call us at 877-927-6648. Just a couple of minutes left. Michael in Massachusetts, are you there, Michael?
Yes, sir.
Yeah,
Thank you for taking my call.
A lot of callers from Massachusetts today.
I have a small question. It is regardless, ThinkorSwim.
Yeah.
And usually, I'm trading for many years, but I don't trade options, so it is my next step. But meantime, I playing box. So I have a core position, and I short or sell, one way or another one. And it is doing for me very well. But I'm confused between Fibonacci retracement, because which one it is first, which one it is last. Because when you're looking, for example, on 1 minute, it is one Fibonacci. On a 2 minute, on a 5 minutes, it's another. And does it any steps which you can take, just for one special Fibonacci analysis?
All right, you're gonna love my answer on this. I have no idea, man. I don't use Fibonacci's. I'm not a market technician at all. Pretty open about that too. it's for the most part, I'm a walking, talking chart. You know, I've looked, for instance, like the spiders. I've been tracking the spiders the last 11 years, pretty much tick for tick. So I actually, I don't utilize those. I don't utilize Fibonacci's. And some of the other guys that do the shows, I know, Tom that uses a lot of Fibonacci's, not Tom Sosnoff, but of course, Tom obviously, in the Tiger's Den utilizes a lot of fibs, and some of the guys in the shows do. But yeah, I wish I could tell you, a little bit more about them. But yeah, not much of a market technician. It's kind of funny is I pull up a chart once in a while to show during the show. That's pretty much for you guys, not so much for me. But
you use Fibonacci. You use same platform, ThinkSwim, right?
Oh yeah, absolutely. I utilize ThinkorSwim. Yeah, we are ThinkorSwim.
Yeah, because you can install a retracement, on your charts and show retracement, but it's confusing for me. Sometimes.
Yeah, no. You know what? Anytime, if you've got like software-related questions, email me directly, and I'll take care of them, or I'll get you to a guy that understands technicals. But the reality is, I understand a lot of the technical analysis, totally understand Fibonacci's and retracements, but it's not something I've utilized in my own trading here. I'm a little bit more of a tape reader. I look at things like bonds, relationship to the VIX, relationship, of course, to the futures, and that's a little bit more of my business, man.
Right. And what's your opinion about IWM? Because does it go in close with gaps?
I'm sorry, I couldn't.
Next day? Huh?
You might have to repeat that one again. I could not hear you.
Okay. Do you have opinion about IWM gaps which we experienced last couple of days?
Oh, you know what? Yeah. So IWM in the entire market right now is just in this period of a little bit of a tug of war, a little bit of a consolidation. But what's interesting about that is IWM specifically, okay, and the Russell has been in. I honestly don't even have it up on my screen here today. The Russell futures on this screen, but IWM and the Russell has been kind of the weaker of the underlyings here. So that's something to keep a good eye on, because this actually could take us a little bit lower here. So keep that in mind there. I don't necessarily think there's a gap coming in the next couple of days, because I think we're consolidating a little bit at this 1290 level on the futures of the ES futures. But ultimately, keep a good eye on it. I'm just not a huge believer that the Russell drives order flow for the rest of the marketplace. Its gap last week was a little bit of an anomaly with the down move, of course, in the entire S&P.
And I very often use, future IWM and IWB, but sometimes it goes step by step with IWM, but sometimes it is or jump ahead or fall down much more than IWM. There's the independence, between these two.
Well, the Russell, you're talking about the Russell future, of course, in IWM.
Right.
They should track almost perfectly. The reality of that is the IWM and the Russell future are tied definitively via servers, but really order flow pumping in the IWM, is typically going to be very slightly behind that particular Russell future. But for the most part, they track almost perfectly. Now, what you will see from time to time is the IWM not tracking, and from no other reason is that there's dividends, payable on there, and that's something that could also, there's actually a little bit of a dividend payable on there. The other thing is the Russell future does have a cost of carry associated with it, meaning that holding a future is a leveraged instrument, and that cost of carry actually adjusts very slightly. So you'll see some differentiation between IWM and the Russell future, which is completely and totally normal, though, on there.
Thank you.
Yeah.
Okay.
Yeah.
Thank you very much, sir.
Yeah, thanks very much for calling in. So, a great caller in there. And, by the way, you guys are absolutely hysterical here in the in the chat room. I'm reading the entire thing. So, Joe D., thank you for that comment, because I almost wet myself laughing over here. It's just killing me there. If you guys kind of scroll up and read over here, I've also got, again, I got like housekeeping in the background over here. It's getting good. There's nothing like doing a radio show live from a hotel. Good stuff. So, got a couple of great callers that have come in today. Just got a few more minutes to wrap up with a couple of ideas that we discuss here. So we were talking a little bit earlier about like market maker move. we were discussing earlier about market maker move, and of course with IWM, you see its market maker move is about 47 cents. And of course, again, that's a normal, all right, where 68% of the time we're going to stay within about that 47 cents move up or down. You know, one thing I do want to discuss, though, is how we derive it, because if you take a look at spiders right now, spiders doesn't have necessarily a market maker move on it. Not every underlying is going to derive a market maker move at this point. And that's ultimately just our development, because this market maker move is kind of new. We haven't been able to deploy it in every single underlying, and that's really a function of trying to get and achieve clean implied volatilities. So what we do is we don't just use one implied volatility and say, oh, the market maker move is based on the historic implied volatility. We don't just use one, implied volatility from, okay, these March weeklies, that looks good. What we do is we use an average of implied volatilities from the front and back month options, and we only average out of the money options. It's very similar to a VIX-style implied volatility. And once in a while, we don't get a very clean implied volatility. And right now, we're in the midst of kind of writing a little bit more code on ThinkorSwim to be able to derive one of these implied vols and more accurate implied volatilities to achieve a market maker move on every single underlying. And we're perfecting it right now. So really, this market maker move just came out the last couple of weeks. It's kind of the first iteration of the market maker move. It's going to get a lot better over time. I like it. I mean, it's something just based on implied volatility. But the bottom line is, it's a cool feature. You don't have to sit there and extrapolate out how far do we think we're going to move today. Or for those of you guys that are complete and total ThinkorSwim geeks, I'm one of them. Basically, this curve here on the side is the exact same thing. And of course, you can kind of drag your little cursor up or down and see how far the stock can move in a given period of time. But that's what we're all about. Is hey. Are a brokerage firm, but we build spectacular technology out there. Be sure over the next couple of days to shoot me an email, answer your questions live next week, and call in, of course, next week. My email is dkaufman, Kaufman, at thinkorswim.com. And, hey, thanks again to Tom Sosnoff for joining us for the show and all the callers today. Be sure to give us a call next week. Thank you guys very much for joining me for the show today. Again, my name is Don Kaufman, and have a good week trading. Thanks a lot, guys. Bye-bye.